Hey guys, welcome back to a brand new video. I'm RexFinance, and today we're going to be talking about 2024 and why I personally believe that 2024 is going to be another great year for stock market investors. Let's go ahead and flash back to 2022. In October of 2022, I posted a video titled "Stocks Just Bottomed and Nobody Noticed." This actually went on to become my most disliked video that I've ever posted on my YouTube channel, which says a lot. People really disagreed with my thesis about the stock market for 2023. And actually, what I predicted ended up coming true. You see, in the stock market, a lot of the times, if you adopt this contrarian mindset, you'll actually end up making the most money. I want you to pay special attention to the price of the QQQ in October of 2022 when I posted this video. You can see on the screen, the QQQ was basically trading at $280. In 14 short months, the NASDAQ has gone from $280 to $410 as of today. In fact, year to date, the NASDAQ is up over 55%, making it one of the best years the NASDAQ has ever had. So why do I believe that after a record year, we're going to have another good year next year? And lucky for you, that's exactly what we're going to be talking about in today's video. But first, if you guys are new here or returning and not yet subscribed, please subscribe down below and leave me a comment what you think the markets are going to do in 2024. This video is not me guaranteeing that I'm going to be correct. In fact, because I was one of very few that predicted that 2023 was going to be a great year, and I actually got that right, I'm probably due to be wrong. So also take this video with a grain of salt. I'm not your financial advisor. These are simply my own thoughts, opinions, and ideas. I will do my best to relay my facts and data points that back my bullish thesis for 2024, but there is no guarantee in the stock market and anything can happen. But the first thing I want to discuss in today's video is actually the bearish thesis for 2024. Most bears right now who still expect a recession or a crash in the markets base their arguments on historical precedents. Basically, times in the past when economic indicators were flashing the signs they are today, and it ended up leading to a recession. So they think because these indicators have foretold a recession coming in the past, it's going to do the same thing today. And there's actually something to this. We can look at the leading economic indicators, for example, and see that they have been cratering. I mean, going straight down. And in the past, the leading economic indicators, or LEI, has correctly signaled the last 8 recessions with an average lead time of 12 months. So this has been a really good predictor of recessions to come, which ultimately usually cause stock market crashes and corrections. Now, why have we yet to see a recession this time around? Because we're sitting at 24 months since the leading economic indicators topped. It was in December of 2021 that the leading economic indicators topped and started to downtrend. So we're already at least 12 months late if these leading economic indicators are again going to correctly predict a recession. Well, unfortunately, most bears just refuse to do the extra research. You see, if you look into the leading economic indicators more, you'll find out that they heavily weight the goods sector of our economy, which we all know the goods sector of our economy has been going through a rolling recession. In fact, the services sector of our economy is what has been holding our economy so strong. And because the LEI overweights the goods economy and underweights the services economy, it presents a really big problem here. And it's perhaps why we've yet to actually see a recession. In today's economy, services make up more than 61% of our nominal GDP. So services make up far more than half of our economy is essentially what that means. And with the LEI underweighting the services sector of our economy, again, that's kind of a big problem when services make up such a large percentage of our overall economy, and services have remained relatively strong. And if you want another fun fact, services used to only make up about 40% of our nominal GDP back when this data started getting tracked in 1947. So it makes sense because services make up more and more of our economy every single year, and because the LEI overweights the goods sector of our economy, the leading economic indicators might be misleading moving forward. And the next leading indicator that bears continue to look at and point to is this yield curve inversion, the 10-year Treasury yield minus the 2-year Treasury yield. This has inverted, and it's been inverted since 2021. And you can see, looking at the chart on the screen now, that any time this yield curve has inverted since 1980, we've ended up seeing a recession play out. But again, we're sitting here today with the yield curve inverted, and we've yet to see a recession come. So why would this be? Bears believe that the yield curve inversion predicts recession or anticipates recessions happening. But I encourage you to think a different way. I believe yield curve inversions anticipate a financial crisis of some sort playing out, and then potentially a credit crunch, which could end up causing a recession. So the yield curve inversion, in my opinion, anticipates a financial crisis rather than a recession. And, think back to March of this year. What happened in March of this year? We had a banking crisis, but it was contained. The Fed reacted to the banking crisis faster and more effectively than they ever have in history. When Silicon Valley Bank failed, there was massive contagion risk. At least people feared that it would happen, that more and more banks would collapse, and that would end up causing our recession. But again, the Fed reacted faster and more effectively than they ever have in history. So there's a chance that the yield curve inversion did yet again correctly predict some sort of financial crisis happening, but because the Fed stepped in so swiftly, we never will end up seeing this recession. And I know it sounds cliche, but this time is different than any other time period in history, which is why we can't look at history to show us what the stock market is going to do. There are simply too many variables out there. I know bulls get made fun of all the time for saying this time is different, but every time is different. There is no more factual thing in the stock market. And unfortunately, because of that, these leading economic indicators that bears have been looking at are going to end up being misleading. They already have been by many counts. But now let's go ahead and move into my bullish thesis, the facts and data points that back why I'm a bull for 2024. And it all starts with this: purchasing power. Another argument that bears have repeatedly gone to is that eventually people are going to run out of their COVID-era stimulus and their COVID-era savings. But they neglect the fact that consumers have so many other sources of income and so many other sources of savings and net worth to them. It's almost like bears believed that the only reason consumers have been spending is because of this COVID stimulus that they still hold on to and have not run out of yet. But that is just simply incorrect. And this is going to play to the fact that this time is different again. You see, COVID stimulus, sure, it helped boost consumer spending in the few years where unemployment was high and wages were stagnated. But unemployment is low now, and real average hourly earnings are rising once again. And really all we have to do is look at the labor market to see that consumers have purchasing power. The labor market continues to produce new jobs, and wages are rising faster than prices again. That wasn't the case last year and the year before when inflation was skyrocketing. Wages were lagging inflation, which meant real wages were going down. That is no longer the case. Wages are once again increasing more than inflation. We can look at the JOLTS report to see that the total job openings still total 8.7 million. In fact, over 8.7 million. And yes, job openings have declined significantly since 2022 and 2023, but this is what the Fed is talking about when they mention they want to bring the labor market back into better balance. We're at a very, very healthy point right now where job openings still outweigh the amount of unemployed people. And then you have the fact that the amount of unearned income that consumers are taking in right now is at all-time highs, and it's not even close. You can look at interest income, dividend income, proprietor's income, rental income. They're all over $1 trillion, and they are all at all-time highs, and it's not even close. This is all money that is coming into the pockets of consumers. Now, kind of piggybacking off that last point, households are wealthy and very, very liquid. And most of the time when markets go down, it's because liquidity has dried up. If households remain this liquid and remain this wealthy, it's going to be very, very hard to see the markets come down. Right now, the data shows that households have a record $151 trillion of net worth. And again, this record isn't even close. We can look at this chart that shows all the different categories that contribute to household net worth and see that, again, every single one of these categories is at an all-time high. And we can also see that a lot of this net worth right now is held in money market mutual funds, where total money market mutual funds in December totaled almost $6 trillion. As interest rates come down, interest rate risk creeps back into people's portfolios, where if interest rates come down, they no longer see the easy, no-risk return that they're seeing in their money market mutual funds. As a result of this, we can expect that a lot of the money sitting in these money market funds will eventually return to the stock market and the bond market. And another argument that bears continue to talk about is that monetary policy is restrictive right now, which means the stock market's going to go down because the Fed is taking money out of the system. But they're forgetting about the whole other half of the equation. You have monetary policy and you have fiscal policy. Fiscal policy right now is very accommodative to the overall economy. The government continues to spend on infrastructure, which helps construction and wages and the economy as a whole. And we can see this reflected on the chart here. New orders for construction machinery is up 30% over the past 2 years. It's going to be really hard for us to see a recession and thus a stock market crash if fiscal policy remains so accommodative to our economy. And as for the argument that monetary policy is restrictive right now, I would just argue that it's normalized. It's gone back to pre-financial crisis levels, which is more normal levels. We're not at 0% and we're not at 6, 7, 8%. And lastly, housing is set for a recovery. Right now, all of the experts are predicting a crash to happen. I don't think so. This is going to be another example of me being contrarian to what the vast majority of people believe right now. I do not believe that housing is going to see a crash, and there's numerous reasons for that. We've already seen mortgage rates decline from above 8% down to 7% and even lower, and that itself is going to be a big booster to housing activity. And how do we ever have a recession if housing is in recovery mode? Yes, we can see a recession if housing does in fact slow down, but I just can't see that happening. It's really hard to have the housing market slow down as you're decreasing interest rates. It's very counterintuitive. Right now, the problem is that nobody wants to move because they don't want to reprice their cheap debt that they got in 2021 and in 2020. If they moved homes, they'd be selling a 3-4% mortgage and likely taking out a new mortgage for 6, 7, 8%. And if I'm correct about this, a housing recovery is also going to give a boost to retail sales, which if retail sales go up, again, it's really hard to see a recession and a stock market crash. Think about it. If people move homes or buy homes, what are they going to spend their money on? They're spending money on new appliances, new furniture, etc., etc., etc. And to end this video, I was going to talk about inflation, but I honestly think everybody now believes that inflation is turning out to be transitory. We saw goods inflation actually down to 0%. Goods are actually going to enter deflationary territory in next month's CPI readings. But this is just yet another bullish catalyst. It's very unlikely right now that inflation is going to see a resurgence. Services inflation has been pretty sticky, but it too has started to come down and dissipate, which I believe it's going to do more of in 2024. But with that, guys, again, please comment down below your thoughts about 2024. Again, I'm not saying I'm going to be correct. These are my own thoughts, opinions, and ideas. I'm bound to be wrong. I'm due to be wrong. But again, if you guys are new here or returning and not yet subscribed, please subscribe down below. And also consider joining my membership. It's the cheapest one on YouTube, and it's the best one on YouTube. It's a pretty simple sales pitch. So please join. We would love to have you join the Discord server and take advantage of all those different perks. With that, have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.